Hello and welcome to this market special from Business Today. I'm Udayan Mukherjee, and with me is well-tracked columnist and a veteran of the stock market, Neelkanth Mishra of Credit Suisse. Neelkanth, always a pleasure having you on the show. But there's a lot to talk about with all that's happened over the last few weeks with the budget, the Adani Group, etc. But I want to start by asking you about the overall mood on India at this point in time, because we are not sure which way the FII flows will pan out throughout 2023. But at the start of the year, there was a lot of talk about how China is looking more attractive relatively compared to India. Have the events of the last few weeks with Adani, etc., buttressed that feeling? Is India looking relatively less attractive as we go into the year?
Yeah, thank you, Udayan, for having me on your show. It's always a pleasure talking to you. See, when you're thinking about investors, one is the view on the economy, and the second is the view on the markets. And I think the view on the economy is still quite rosy, especially on the relative basis. I think India is one of the few economies with a fair degree of visibility on medium-term growth. The challenge for the last 16 months, and that continues, has been on the markets because they were pricing in a lot of that optimism by, I think, August, September of 2021. And since then, we have seen this period of consolidation, which I think can run for another year or so. Now, I'm actually less in the camp of the India versus China trade, meaning that if China does well, then India does badly, and vice versa. Uh, I'm more in the India and China trade because when we did this bottom up analysis of 6,300 funds, we realized that even during the period in which we saw significant FII selling from India, the India weight in those funds did not change. And what that suggests to me is that they were trimming off on India because EM funds were seeing outflows, Asia funds were seeing outflows. So as optimism came back around China, and of course that market has moved up 50%, India started to see its own share of flows. And I think the tug of war between domestic and foreign institutions is likely to continue because a lot of the domestic institutional flows are what I call the unintended flows, meaning I put money or my some deduction from my salary goes into EPFO, and then EPFO puts 15-20% into the stock market. I don't, but some people do buy guaranteed return funds from insurance companies, and a lot of that money goes into equity markets. A lot of the folks buying SIPs are more looking for beating fixed deposits over a medium term, and therefore are not really, investing in equities directly. And therefore, I think this tug of war between unintended but very large flows of capital domestically keep the market a bit more expensive than it needs to be, and FIIs keep selling. And on that measure, I think we have actually corrected quite a bit in the sense that the India premium to the world on price to earnings used to be close to 60% at the peak. It has now corrected to around 20%, which is kind of middle of the range of the range that we saw in the prior decade. So it is less expensive relatively than it used to be, though I think there is still a bit of correction that is due.
So you said that this consolidation might well continue for another year. So do you expect the market to basically tread water and not do much, or are you expecting a significant price correction from here as well?
No, I think it would just tread water. So I tread water because I think the strategy of buy the dip, which I don't think is much of a strategy, though it has been reinforced by what happened during COVID. And a lot of people have made a lot of money, and therefore every time the market falls, there are new flows that come into the market. So I don't expect significant absolute correction to happen, but the roll forward support that we get, basically a year from now, we'll be trading on FY25 earnings, which are as of now supposed to be 13-14% higher than FY24 earnings, which is what we are trading on now. And therefore the market then starts to look quite reasonable on price to earnings.
Mm. What about the Adani Group episode? Is that a factor at all in coloring sentiment for the kind of people that you spoke about, the domestic crowd or the foreign institutional investors that you may be speaking to?
Look, when people buy, I mean, there are very few people or institutions that buy ETFs. They are Nifty ETF, right? So maybe the EPFO buys Nifty ETFs, maybe a few global macro funds buy Nifty ETFs. Everyone else buys stocks. So the index values that we see are a combination of the result of the buying, selling of individual stocks. And there is no reason why someone should feel less comfortable about Indian IT names or Indian bank names because of the events of the last couple of weeks. So there is a lot of chatter. There is a lot of course, commentary in the financial media. But as you would have noticed in the last couple of days, that is slowly starting to die off, right? So basically the news flow on that, I think, in the next week or so, maybe 2 weeks, is going to become, overshadowed by new developments, and people will forget about it. So I don't think that will have a very lasting impact on the Indian market.
Mm. I want to talk a little bit about the union budget, but I want to start off with the micro aspect of it, which because you spoke about insurance products and money coming into the market through insurance products, and it is the one space which got hit very badly on the budget day and thereafter. Have you, as a house at Credit Suisse, downgraded your view on the sector after what came through in the budget, insurance?
So we have been very negative on life insurers for I think about 2 years now, because we even when we initiated coverage on the names, you remember 2 years, 3 years back, there was a whole spate of new listings. We highlighted this point that they are life insurance companies, but they are more of asset managers, and asset managers' earnings don't deserve this kind of multiple. And in a way, we were worried and cautious about exactly this kind of regulatory arbitrage that they were benefiting from, and that it could get closed at any point. So we've been underweight that sector, and we've had neutral or sell calls on all of those names. On general insurance, of course, we are, and then health insurance, we are a lot more constructive. But those firms don't sell these products.
Mm. You said that the Adani Group should not change a stock picker's view on what companies he or she is buying, and but the one space which got hit quite badly during that whole saga were some of these public sector banks which have exposure to Adani. But how do you see the impact on the banking system at large, and does that reinforce the market's differentiation in the PE multiple or the price to book multiple, which it accords to private banks versus public sector banks? Seeing that once again, when there was a tricky issue, it was the public sector bank which had the exposure to questionable assets, but the private sector did not.
See, some of the impressions are very hard to do away with, right? Which is why we think that the valuation gap between private and public sector banks is not going to narrow very quickly. So conversations with investors suggest that because these stocks had moved up a lot, they were sitting on significant gains. So at least the folks who had bought these stocks early had been sitting on gains, and so at the first whiff of a risk, they just booked profits. And I don't think fundamentally there is any additional risk of defaults or bad loans that can come through for the PSU banks, and therefore we remain quite constructive. We are a bit selective among the PSU banks. Remember that these banks still have lower return on assets than many of their private peers. They, as you said, have credit standards which can create problems over the medium term. But at least over the next 12 to 18 months, we don't expect their NPAs to start worsening. And to some extent, given that there is now greater competition for deposits, their stronger deposit franchises, the fact that they're sitting on a lot of excess SLR. So for the higher quality PSU banks, I know there is a gradation between them as well. The valuation gap between the private and the PSU banks has again become quite wide, and I think they provide good opportunity.
Speaking of the public sector, Neelkanth, were you a little disappointed or surprised about the lack of enthusiasm in the budget speech about disinvestments, or was it because of the poor track record of the last couple of years, and especially it being an election year, that the finance minister knew that there would not be significant progress made this year as well?
So, see, the government's political commitment to disinvestment and privatization has been quite strong, right? So, remember that the oil marketing companies were earmarked for privatization back in 2016, and here we are in 2023, and we still haven't seen that happen. So, there are, I think, significant execution issues. And the government, if you remember, 2 years back, 3 years back, had given a very large privatization target, and it was not able to meet that because of very slow progress on some of these moves or some of these disinvestments. And so I think there is an element of fatigue, I would say, uh, uh, among the politicians in the government that, look, we are committed. We want to emphasize the fact that the government needs to be small, does not need to be in the business of running a business. But somehow the machinery is not able to do that. So I think that pressure is still on. If you remember, I mean, if you there is a 51,000 crore disinvestment target this year, but incrementally, I think as a percentage of receipts, it is becoming less and less important. There have been some comments made by the ministry that they're also running out of assets to sell. So other than the asset monetization, suppose for transmission of power or road assets or other assets which can be sort of packaged into something that can attract investments as guaranteed return products or something, the number of assets available for sale has also dropped, which I disagree with. I think there is still a lot that can be sold off, though I think that the process of selling those is likely to be quite cumbersome, and so the budget commentary kind of de-emphasized that process.
So, do you see assets like IDBI Bank or Container Corporation being pushed through this year, or again getting mired in these kind of delays?
So some of those I think will happen. So remember that there is 51,000 crores of disinvestment budgeted this year, and that pressure I think is very much on. The some of the changes that we saw in the finance bill also point to the process of sale, or what I would call one of the prerequisites that came out from the initial RFQs that the government issued for privatization of one large bank. So my sense is that process will continue. On others, I don't think I can talk about specific names, but I suspect that progress will be slow.
This thing that you alluded to just now about the government being or staying away from the business of doing business, that was the stated intention a few years ago. But everything that's happening on the ground, I mean, the government is assuming a bigger and bigger role in capex because private capex is still not picked up. It's not ceded that space through privatizations. Do you get the sense that there is a rethink, or this is just a temporary phenomenon of the government doing all the heavy lifting on the economic front?
It is more of the latter. So if you think about the biggest policy challenge while the budget was being made, it is that the debt to GDP is still quite elevated. And for it to fall or start falling, you need to bring the primary deficit. So basically, the fiscal deficit minus the interest payments that you make, the primary deficit has to fall close to zero. Now, primary deficit is close to 3%. The challenge for the government is that if they consolidate too fast, then there is a problem that you slow the economy down. And if you are starting, because as you know, in the debt to GDP ratio, the denominator is as important as the numerator. Basically, if your nominal GDP growth slows down, then your debt to GDP cannot come down. So you cannot consolidate into a lower ratio. You have to grow into a lower ratio. So you need to bring down your primary deficit, but at the same time, you cannot reduce it too fast. Otherwise, you get into a debt spiral. So the objective for the government is a slow and graded reduction in the fiscal deficit. Now, once you do that, once you have that objective, how do you spend starts to matter a lot more. So if you need to keep expenditure levels high, your expectations are that subsidy payments are going to be lower this year in FY24 than they were in FY23. And what do you do with that extra money that opens up? And so spending it on infrastructure, and and I know, uh, we need to have much more of railway capacity, much more of road capacity, and that expenditure continues to happen. Remember that the railways is still a department of the government of India. There is no possibility for the private sector to invest there, and we need a lot of investment in railways. Same in the national highways, right? So in national highways, I think the government's hybrid annuity plans or various models where it takes on the upfront risk for construction has proven to be the right one because the pace of construction is actually accelerated. There's no reason why the government should not continue spending on national highways. I have a minor disagreement with your comment that private sector capex has not picked up. I think it has, right? So if you see the results of most of the industrial goods companies, some of that or the order books are also about replacement capex like automation or cleaner environment and all of that. But there is clear evidence that capex is actually starting to happen.
So what's the way you're loading up your portfolio at Credit Suisse in light of what you've just discussed over the last 15, 16 minutes? Is it tilted towards capex? Is it tilted towards consumption? Is it tilted towards domestic versus export-oriented sectors? What is the thrust of your portfolio selection?
So the first is that it is domestic versus external. So I have a lot of concern on what's happening in the world. This is not just for this year, where we could potentially see a financial markets accident. I'm hoping that we don't. There is a possibility that we don't, but it is quite possible that we may. And so I'm very cautious on that, on the external environment. The domestic environment, I'm quite positive on. I think the domestic economy is slowing, but from a higher base, right? So people think that we are at 7% in FY23 and we'll slow to say 5.5% in FY24. I think we are closer to 8.5% in FY23, and we may slow to 7% in FY24. I'm talking real GDP growth. So domestic investments, I would be positive on, but not on industrial goods. So on cap goods, the metric that we rely on the most, which is how many standard deviations above or below is the sector versus its 10-year average. So on that, industrial goods, capital goods comes out right at the top. So it is meaning that it's the most expensive. And I also think that global goods demand is going to stay subdued, and goods are far more tradable than services. And there is a clear risk that our exports can suffer. And there is also, in the next couple of months, a potential risk of dumping of foreign goods into India. So there is a possibility of a negative surprise on some of the order books for cap goods companies. Same with Indian IT. So Indian IT has corrected. Now it has bounced in the last 2 months again, but the P multiples are a bit lower, but still too high for our comfort. Great sector to be in, great cash flows, excellent management. They will never see, or not never, well, very unlikely to see negative growth. But we think that there is quite a bit of disappointment on revenue growth, which is still ahead of us. We like financials because we think credit growth will sustain. We like cement. We think construction of real estate as well as of infrastructure funded by the central and state governments will be strong. We like staples over discretionary because we think that the discretionary demand had risen much above trend last year, and it is now coming back to trend, but on year-on-year numbers, it will be disappointing. Staples, on the other hand, was very badly hurt because of the bottom of the pyramid struggling. Now that those jobs are coming back, we think that staples gives us the best exposure. Remember that there is also a return of the informal sector, that the small sandwich wala below our office, or the small restaurants, the Shiv Sagar, the Sukh Sagars of the world. I think they've all now reopened. There is a lot more of competition that the existing restaurants will face. The same for transportation. And remember that the bottom half of the population is not as brand conscious as the top half of the population. So therefore, on things like apparel, jewelry, the share gains that some of these sectors saw in the last couple of years, the post-COVID, is some of that will be ceded to the informal sector. Staples has much deeper penetration and therefore should be somewhat immune to it. So we prefer staples over discretionary.
Mm. Finally, having heard from the Reserve Bank of India, what's your sense of how this fixed income versus equity market return debate which is going on will play out? Because fixed income looks more attractive than it has in a long time now.
I absolutely agree. And if you plot the equity risk premium, right? So the excess return that investors demand because they're investing in a slightly more risky asset class, which is equities. ERP in India, strangely, is negative in the sense that, and what that means is that Indian government bonds today are cheaper than Indian equities, which is ridiculous, right? I mean, basically, Indian government bonds are supposed to be the risk-free asset. So we think that bond funds and bonds themselves are going to generate much stronger returns in the next year or so than equities.
Neelkanth, always a pleasure talking to you. Thank you very much for dropping in with your thoughts today. Thank you.
If you like the video, do like, comment, share and subscribe.